and over the last several years, about 64% of the plans we worked on have involved phantom equity.
We have to understand that all this can be implemented better if there is a formal entity in place. Everyone here in the audience who operates as a sole proprietor, yes, you can share equity, but you expose yourself to more risk. You might not have a formalized structure in place that allow you to govern that relationship with a new partner.
To start before you need to. We've definitely heard clients say, I wish I had done this sooner. Hello and welcome everyone. So today we'll start with the foundation, starting with what is equity. Then we'll talk about the key foundational elements to address before or maybe while you're building your equity sharing plan. From there, we'll talk about strategies, and then Nicole will help us understand the importance of organizational structure considerations. And lastly, we'll wrap up with some implementation tips and best practices. What is equity? What do we mean when we say or use the word equity? Most people often immediately think ownership, but equity sharing can really mean a few different things. At its core, equity is an economic reward. It's a retention tool, and in some cases, it is actual ownership and sharing of control. But one of the biggest misconceptions that we see is firms assuming they have to immediately give away ownership in order to create incentives, but that's definitely not true. There are ways to create financial participation without giving up control, and that distinction becomes really important depending on what your motivations and goals are. For example, if your primary goal is retention and creating performance initiatives, a phantom equity plan may be a perfect solution. If your goal rather is focused on future ownership, offloading, and succession planning, then maybe a true equity ownership plan will make more sense. So, obviously, today I want to help you think through those differences and again, hopefully, walk away with a better understanding of what not only your options are, but what the best options are based on your goals and motivations. So, before you start implementing a plan, you have to ask yourself why and who as it relates to equity sharing. Because if these aren't clear, the plans usually become, or the creation of the plans can become messy. And strategy and structure really do work best when it's aligned with your actual long term goals for the firm. So, the first step in creating an effective equity sharing plan is determining your why. Once you know why you are doing this or can answer that question, it becomes a lot easier to identify who should participate, what plan of your options make sense, and then how that plan should ultimately be implemented. We also encourage firms to think about things like employee career tracks and building those out more intentionally. Your organizational structure. So, again, making sure that that is set up in a way to support your why. Your valuation, having an idea of what you actually are sharing as the valuation relates to or establishes what that equity is, and your long-term business goals. So, because all of these things work together, what we see pretty frequently is firms jumping directly into a plan design before they've clarified that bigger picture or again considered their why and the long-term effects of how those align or not. So we really want to make sure that you're thinking about the mapping of what your long-term objectives are before we jump right into that plan. So again, spending time on the foundation really does matter. There are usually three primary reasons that firms explore equity sharing. So, those motivations, and those are the three on screen here. First, internal succession planning, also creating performance incentives, and then retention. For a lot of firms, it's actually honestly a combination of all three of these, or they play a role collectively. Internal succession planning, the hot topic because it's so important to think about and start mapping well in advance of a founder's transition, of their ownership for their retirement. So ideally, this happens very intentionally, well in advance. Maybe like 10 to 15 years would be ideal to start mapping this out. So it does come up pretty early on, in I'll say a business's life cycle, or at least for founders. Performance incentives are another major driver, as firms want employees thinking and acting like owners to build the horsepower behind company growth and the overall success. And then, of course, there's retention. We jokingly refer to equity sometimes as golden handcuffs, but there is truth to that. Equity sharing can create a powerful long-term incentive for key people to stay invested in the business. I'm sorry, as you could tell, I have a little bit of a tickle in my throat, so I'll mute myself so you don't have to hear this. All right, bought me some time. One of the top reasons that arguably, I would say most firms should be interested in equity sharing and understanding the right way to structure and share equity is because of the impact that it has, on enterprise value and value retention. So your long-term economic. Sorry. This is a critical consideration and motivation for aligning your equity sharing strategies with your long-term goals to ensure that you're building a plan that creates a pathway to achieve your goals rather than fight them. For example, a lot of businesses historically have shared equity in the form of client relationships or group of clients. That's easy to understand. It's easy to implement because there really isn't anything to implement, and it's easy to track. However, sharing equity in the form of client relationships significantly impacts business value and honestly the viability of many long-term exit strategies, probably more than you think. So let me walk you through the example, the financial example that's on screen here, for the numbers people in the group. On the left side, we are looking at a scenario where equity is shared in client relationships. And on the right side, we're looking at equity shared in the overall company. In both cases, we're starting with $1 million in revenue and assuming a 3 times value. Over time, revenue grows, and in the first example, when the employee leaves after 5 years, so on the left here, they take associated clients or the clients that they have ownership with and the revenue that comes along with those clients. That means the company permanently loses that revenue when the employee leaves and therefore permanently losing a portion of the value. The impact of sharing equity in client groups is honestly equivalent of paying advisors production splits. It's essentially a cost right off the top that directly detracts from your overall company value. This is really a book building strategy for a siloed business model, not a strategy to support internal succession planning or long-term value building. On the right side, the employee still participates economically, however, through ownership in the company. And here, the clients and the revenue remain centralized within the business. So over time, that difference becomes pretty significant and results in almost $1 million difference in company value by the end of 10 years, which is probably a pretty realistic retirement timeline for a lot of the listeners today. This is why it is an important mind shift. A lot of firms, as I mentioned, historically have rewarded advisors by carving out pieces of client relationships or giving them what they've sourced. However, more firms today are trying to build a team-based or ensemble-based business structure because this is what's creating that true enterprise value that survives well beyond any one individual advisor. Sorry, the slides were a little glitchy here. Okay, so once you understand your why, whatever your why is, the next question becomes who should participate? Most commonly, firms are sharing these plans with key employees, the first one on the list here. So think individuals who are driving growth, leadership, efficiencies, or long-term value. However, some firms make plans available to most or all employees, and that can absolutely work. But it's important to think about the, again, long-term alignment of that plan as it relates to your goals, especially if the long-term goal is internal succession. This is because what we've seen in situations where equity is shared with most or all is that future owners or your next gen internally can become frustrated if equity is being broadly shared with individuals who don't necessarily carry ownership level responsibilities like maybe they do, but get to participate in the economic benefits. This is where defining culture matters a lot because every firm defines key employee a little bit differently. Some firms focus heavily on revenue producers as key employees. Others prioritize operational leaders or culture builders or a combination of. So there are a lot of common pathways, but rarely one right answer. Equity sharing plans can also apply to existing owners or contractors or even outside parties in acquisition scenarios or as a recruiting tool. So there's definitely uses and motivations outside of just internal succession planning or retention. And the best way to remain intentional and consistent with your who is to communicate equity opportunities through clearly defined career paths. This is because career paths can help employees understand how they can grow, what expectations exist, and what compensation opportunities may exist over time. This is an example of a high-level career path across producers, service, operations, and investment roles. Um, there we go. And as you can see here, a lot of firms use phantom equity as a first stage or an early stage incentive, and then introduce real ownership opportunities later in someone's career progression. This will help you communicate creating a career track or an intentional pathway will help you communicate more directly and confidently with your employees about their long-term career progression and growth opportunities within your firm. Because I promise, even if they haven't asked yet, they do want to know what success looks like with your firm. How do they advance? What opportunities exist for them long term? So if career pathing is done well, equity conversations and overall equity sharing from you being the primary owner or leader of that equity creation, those conversations will feel more natural and intentional and part of a much bigger career development conversation. So now that we've covered the foundation, let's talk about strategy and what those are and the actual plan options that you can consider. At a high level, there are two main categories, phantom equity plans and ownership equity plans. Ownership equity means true ownership, and phantom equity at its core is a deferred compensation arrangement that mimics ownership economically without actually transferring ownership rights. So there are, of course, several important differences to highlight, which we have on screen here. We'll start with phantom equity, and that is structured around the fact that participants don't receive any decision-making power. They don't have rights to see financials of the company like an owner would because they aren't becoming a real legal owner. Ownership equity participants, on the contrary, may receive some or all of the rights, like decision-making power or the economic benefits, depending on the operational structure you have and the available ownership classes maybe that you have at the operational level. Another important distinction is the participation eligibility because phantom equity plans are often structured as top hat plans, meaning they're reserved for highly compensated employees only. And this is very intentional to help firms avoid ERISA and certain Department of Labor requirements, including some pretty serious annual compliance costs. Ownership equity plans provide a much broader flexibility regarding who can participate. We'll talk a little bit about that as well. Um, Payout structure is different as well. Phantom equity awards often require payout within a relatively short time frame after vesting and exercise, whereas ownership equity can be held long term, establishes basis, and then redeemed with, as most people would argue, more favorable taxation. I'm just scratching the surface here, though, and we'll get into more of these considerations shortly. I also thought it might be helpful to show you what firms are actually implementing in practice. And over the last several years, about 64% of the plans we worked on have involved phantom equity. And among those, appreciation rights plans have been the most popular. In case you're not familiar, we'll get into what that means, what an appreciation rights plan is. But a big reason for this is due to the flexibility. Phantom equity plans are easy to implement, they're easy to modify, and require less commitment, at least organizationally or operationally. As I mentioned earlier and illustrated through the career track example, phantom equity plans are also used commonly as a stepping stone or prerequisite to real, we'll call it ownership or ownership equity. It allows firms to test that alignment with this individual and create additional incentives before introducing actual ownership and bringing in a new, true partner of the firm. So let's dive a little deeper into the phantom equity plans to start. At a high level, phantom equity plans offer, as I just mentioned, a high level of flexibility or discretion, especially when structured properly or as we would argue, properly as a top hat plan. Phantom equity plans are restricted, meaning they are subject to vesting. And one of the reasons they're so popular is because, again, they're flexible and relatively easy to undo or unwind, either altogether or some specific decisions that were once made if circumstances change. And that flexibility can be very valuable. A key decision in deploying a phantom equity plan is whether the award will track with total company value or only the appreciation in company value. And that distinction creates the two primary types of phantom equity plans. The first, which I mentioned a couple slides ago as the most commonly used phantom equity plan, is the appreciation rights plan. These are referred to as either equity appreciation rights or EARs, unit appreciation or stock appreciation, if you're familiar, or if any of those ring a bell. But how this plan works is it's only rewarding participants for future growth in company value. The second option that's on screen here is the liquidation rights plan. And this plan tracks with the total value of the company, meaning participants are effectively sharing or receiving a portion of current value plus the future growth, not just the growth. The practical question here then becomes, are you rewarding someone for what they helped build historically, or are you rewarding them for helping build future value? And that usually helps guide the recommendation of which plan makes most sense. So let's walk through a quick example, again, some more numbers here. Under the appreciation rights plan on the left, the participant only benefits, again, from the growth above the initial grant date value. So if the company grows from $10 per share to $15 per share, the participant will receive that $5 increase times the number of appreciation rights that they were granted. Under the liquidation rights plan on the right, the participant participates again in the full value. So instead of receiving only the appreciation amount or that $5 of appreciation per share, they're receiving the full share value at exercise times the number of liquidation rights that they've been granted. The liquidation rights plan then can be a powerful tool for rewarding someone who has already significantly contributed to company value because you're sharing value on day one. Whereas the appreciation rights plan are more commonly used and often better used for incentivizing that future growth. So, inviting someone essentially into this appreciation rights plan because they've shown what it takes to earn participation, but they're only receiving that award as value based on future growth. This is why context matters because the same plan isn't necessarily appropriate for every employee, and there can be room for both. There are circumstances where it may make sense to have both plans depending on the targeted participants on your team. When structuring phantom equity plans, we also have to determine how grants are earned then and when they vest. So, how does someone actually, I'll say, earn the award, which is cash compensation from them? I strongly recommend tying grants of phantom equity to measurable performance criteria whenever possible. So that might include revenue growth goals, net new asset targets, profitability targets, maybe leadership goals, or other operational achievements if it's not a producer role. Tenure can absolutely be part of the equation or consideration, but generally shouldn't be the only factor. So maybe we're layering tenure on to one of these other performance metrics or targets. Then we move into vesting. The two most common approaches in terms of the structure of vesting would either be gradual or cliff vesting. Gradual meaning it vests or payments are made over time, whereas cliff is payment made at one time and usually tied to a specific event such as the participant's retirement. So they've stayed with you and worked for you through their entire career. Maybe sale of the practice. So if you fully liquidate, or some other maybe defined service milestone. So number of years. And this is where firms can really start to customize plans around, again, your objectives because we don't have a one size fits all here. And depending on what you are putting this plan in place for or as a benefit to achieve, it may make sense to use these longer term event based vesting criteria or maybe a shorter service milestone. So now let's talk about some of the other equity sharing options, and that being true ownership equity strategies. Once we start talking about actual ownership or partnership, we're also talking about corporate governance, what decision-making powers you may be sharing, fiduciary responsibilities that these employees will take on or have, and long-term partnership dynamic considerations. This is why candidate selection becomes incredibly important because you are not just simply rewarding a high performer. You're potentially adding a future business partner, which means you are needing to evaluate leadership, culture fit, communication style, decision-making ability, and again, considering that long-term alignment with your business goals. So, something that I would want you to consider is a statement that not every great employee necessarily wants to be an owner, and not every great employee should be an owner. These are very independent or different things, and ownership should absolutely be earned and very intentionally shared. So, not just considering this as a form of an award. When we talk about real ownership equity, there are three primary ways that you can share ownership equity, either by granting it, by selling it or purchasing it, or by swapping it or through an equity swap. Each of these pathways or lanes works very differently depending on, again, what your objectives are, so your why, and potentially even based on the dynamics of what you've promised a participant or a buyer, or could depend on what you've awarded in the past based on what your overall business strategy was and how that's evolved. So it really matters in determining how you are sharing equity based on potentially what you've already committed. We'll start with the first one on that last slide there, equity grants. Equity grants involve giving ownership rather than, of course, requiring someone to purchase it as the alternative. Grants may have restrictions or vesting, but they also may be immediately earned, so unrestricted. Sometimes the equity is retained long term, and sometimes the company redeems it or requires it to be redeemed upon vesting, and therefore participants really are just receiving a monetary award instead of the use or action of having equity ownership. From a tax perspective, grants are generally treated as compensation, therefore subject to ordinary income and FICA taxes. And in some cases, an 83B election may be available, if you're familiar, which essentially allows a grantee to accelerate taxation earlier when the value is lower, hypothetically. But this option is very dependent on both your operating entity and tax election and the nature of what features I just mentioned above. If you have a non-restricted grant, then they're not going to be deferring taxes because it's immediately received. So in general, a grant plan is used given these different structures and ways that you can design a grant quote unquote plan. It's used for individuals, though, who have already contributed significantly to building company value, so maybe a little bit closer aligned to that liquidation rights plan on the phantom equity side. So maybe you'll hear people reference equity granting in terms of why someone would be granted equity based on their sweat equity. The granting criteria here is pretty similar to that of the phantom equity plan, or that last slide that we looked at. Again, with the idea that you are rewarding someone for something or multiple things that they've done or accomplished to earn the rights of something more valuable than, say, an alternative being a cash bonus. So again, I strongly recommend tying awards to measurable goals and the activities that would demonstrate leadership qualities. One important difference, though, is that you can grant equity that is immediately vested, as I mentioned, meaning it's awarded, so you are adding a partner now. So if that is not the goal, then a restricted grant with either gradual or cliff vesting would be more appropriate. If they haven't earned it through sweat equity or some other rationale or reasoning, then you're selling equity, which is a purchase plan. In these plans, the buyer purchases ownership, and the plan can either be built to support a flexible timeline or schedule or a more structured, predetermined schedule of equity. So think about the amount that's purchased, the frequency that it is purchased or future purchases, as well as the terms, all being predetermined or just determined as you go or later. One of the reasons that firms that use these plans have chosen to implement them or have gone this route where it's being purchased is because it creates real commitment. The buyer has financial investment and therefore has made the financial investment, therefore has skin in the game. And from the company's perspective, this can help founders take some chips off the table over time. So it often aligns nicely with long-term succession planning naturally. The last lane here, being an equity swap, is slightly different and more narrowly used. This usually occurs when someone contributes a book of business or a list of clients that you've given them equity in exchange for ownership in the company. So this would be relevant if, like in my previous example, when you've maybe shared equity in client groups and you want to say unravel this arrangement or plan, have the employee contribute their equity value from this client group to the company, and they receive equity ownership in the whole company in exchange. The resulting ownership percentage is generally based on the relative value that they've contributed. So, for example, if someone contributes $1 million practice or group of clients in terms of value into a $3 million business, they would have a resulting ownership of 25%, hypothetically. These types of transactions can become more technically complex depending on the entity structure and tax treatment. So it is definitely an area where we would suggest involving industry experts like ourselves and technical professionals like CPAs as early as possible, because it can be important to consider where you have flexibility or what the overall strategy should consider depending on, again, what your current structure allows. So at this point, we've covered the different equity strategies themselves. So Nicole, if you would, walk us through what I would say one of the most important and often overlooked components of equity sharing is, which again is organizational and entity structure. Because as we both know, even the best designed plans can create some major problems if the entity structure beneath it isn't built to support it.
Absolutely. Thank you, Julia. So now that we've discussed the different types of equity sharing plans, the next question is, what does equity actually mean at the business level? And I think we can all agree that equity is intended to represent value, but before value can be shared, we need to understand where it actually resides. And in many advisory firms, that means clarifying whether the goodwill, which is your business value, belongs to the individual advisor, or if that goodwill is something that we can document and record in the operating entity. So my focus is now on how to structure the organization so equity sharing is tied to the right value, it is in the right place, and will be shared under the right terms. So when we look at the organizational structure, we have to understand that all this can be implemented better if there is a formal entity in place. Everyone here in the audience who operates as a sole proprietor, yes, you can share equity, but you expose yourself to more risk. You might not have a formalized structure in place that allow you to govern that relationship with a new partner. So the entity will help consolidate all of that. First of all, we want to make sure the entity is the place where the value resides, where the revenue ends up, and also where you hold your operations, because we have to make decisions with our partners with respect to our operations. It is also the place where we can create formal rules with respect to how we want to manage our business going forward with a business partner. The entity will also give you personal liability protection. So if you don't have that entity in place and you add a partner, you basically operate as a general partnership. And now you could potentially be liable for the acts committed by a partner. And then last but not least, entities are set up into perpetuity. You usually use them to be a contracting party on your lease agreement for your employees, any utilities you might use, technology vendors. So that entity stays in place regardless of who the owners are. So as you transition ownership, maybe as part of your succession plan, you can easily transfer that over to your successors. And usually entities also have the documentation in place that then provide for that transfer. So you will have provisions that document how value is determined, how we pay for it, what happens if somebody leaves prematurely due to death, disability. So all that is regulated in a formal entity. So because we talk about equity sharing here, I want to make sure we cover three main points. If we could go to the next slide. Thank you. These main points are the enterprise value. We need to make sure that the value actually resides on the level where you share the equity. We also need to talk about governance. So I saw earlier that some of you are concerned about giving up too much control. So I will share some elements with you that help you regulate how much control you are actually giving up or not. And then last but not least, we will cover how an entity's tax status will influence certain equity sharing options. So first up, let's talk about the value because it is not always a given that the entity you might have for your operations has your business value. For those of you here in the audience who operate your own RRA and you have an RA entity established, we can presume you're set up in a way that makes equity sharing easy. Usually that entity holds the contracts with your clients and therefore is presumed to have the ownership of the goodwill, and revenue flows directly to your entity. So that's exactly where we want to end up. But for any folks here in the audience who have an affiliation, either with a broker-dealer or an RIA, there are some extra steps that we have to take to make sure you actually are ready for equity sharing. And the reason for that is the entity you have doesn't have relationships with your clients. There are no contracts. They don't have any interaction with your entity. That resides with you personally. So you start off as the personal owner of your goodwill or book of business. And in addition, the revenue usually also flows to you directly. So we need to make sure that all of this ends up in the entity. With the goodwill, we can do that easily through legal paperwork. So that is something that we help teams with to establish that the entity actually owns the goodwill. When it comes to the revenue flow, we would need to make sure there are certain elements in place. So for revenue flow, if we go to the next slide, you can see that most of you might be set up just the way you see it here on the slide, where you receive your revenue personally as 1099 income. It is reported to your Social Security number. So what has to happen to get that revenue into an entity, on the practical side, you just take that out of your personal business account, how I call it sometimes, and you put that into your entity's business account. On the tax side, this might raise some questions. An auditor might say, well, if you're the owner of that income, you should also be the taxpayer. So what is the reason for you to put this income into the entity and then report it there? And the answer here is that you operate a team, you added another partner, you and your partner generate this income together, and therefore need to have access to that income together in your entity, because that's where you cover your expenses, you make certain investment decisions, and then the remaining income is distributed as profits to the owners. So we'll have to put a few elements here in place so we can help you reduce your audit risk, one of which is that we need to set up a contractual basis for that assignment of the income. We also need to work on the control over that income. So even though you might be concerned about giving up too much control over your business, what I'm talking about is a very narrow control item here, and that is just simply how revenue flows from you personally into the entity. So the assignment itself should be subject to the consent of more than one owner. That way you can establish that you are not in sole control. And then last but not least, an element that we also need to consider is a salary. If you do operate an S corporation, you're actively involved, any auditor would want to see a reasonable W-2 salary paid to the owners. So that is the flow of revenue. We also hear sometimes concerns about compliance considerations here by paying, for example, brokerage type revenue into an entity. There was a recent no action letter from the SEC last year that did confirm that advisors can put that type of revenue into an operating entity so you can cover your expenses. There are some few more nuances that we typically help teams with to make sure that this is still utilized properly once that revenue ends up in the entity. But the short answer here is you can get that revenue into the entity as well. The next element, and I saw that earlier in our poll, that we would help you streamline a little bit more for equity sharing purposes is control. That often is raised as a concern as you bring on a partner. How much control do you actually give up? And the answer is here that you don't have to give up any control if you don't want to. We can do that through different ownership classes. We can also make sure that the entity's management structure is set up in a way that allows you to manage a lot of that control until you're ready to give some of that control up. And then last but not least, by also customizing your voting requirements. So if we take a closer look at these ownership classes, here we often implement 3 different types of ownership classes, from voting to non-voting and to liquidation units. Those are ownership classes that you commonly see implemented in LLCs, taxes, partnerships. With S corporations, we're a little bit more restricted, so those liquidation units unfortunately are not an option if you do have an S-Corp. But the other 2 ownership classes are something that you can implement. The main rights associated with an ownership is voting rights, profit rights, and liquidation rights. And you as the founder can have all 3 of those rights. And if you're not ready yet to give up any voting power, you can consider issuing either the non-voting shares. So here the owner would receive profits and liquidation rights, meaning at the time when they're ready to sell their interest, they get the fair market value for those shares, or even just the liquidation shares. So here you don't give up any profit or voting rights. You are just sharing a pro rata interest in the value of the company. So that's one way to regulate control. The other one is through the management structure. So if we go to the next slide, you will see a common management structure or 2 common management structures for LLCs. The most common one is the member managed LLC. So here we only have one group of decision makers. It is the members with voting rights. So only the members with voting rights get a seat at the table and then vote based on their voting percentages. And I say voting percentages here because if you start using non-voting or liquidation units or shares that I mentioned earlier, those holders are still owners, but they do not participate in voting. So your voting percentage might be higher than your actual ownership percentage, but key here is this is how you can regulate control. You might start someone off with non-voting units, and then later when you feel like they're ready to take on more decision-making power or authorities, you convert them over to voting. If you're too concerned about that, or you don't want to have that conversation about voting and non-voting, you could also consider a manager-managed LLC. This is a structure that mimics corporations where you have members, just like shareholders, elect managers. In corporations, they're called directors. You could be the only manager making most of the decisions, and there might be some decisions, just a few, that are left for the members to decide, including yourself. that pertain to either the life of your entity or the rights and responsibilities of the members. So that's one of those structures that might work well for certain founders if they're worried about control. But typically we see this type of management structure more for larger companies with a lot of partners where you have to worry about efficiencies. So and then the
Nicole,
last
we had a
level,
question come in
oh, of
if
course.
you don't mind,
Mhm.
on the non-voting shares specifically. Under S-Corps, is there any ability, the question is, to restrict profits on non-voting shares?
The short answer is no. For S corporations, the liquidation and distribution rights of the owners have to be based on ownership. So you cannot create a different share class for distribution and liquidation. If you would like to utilize different ownership classes, give us a call. There might be an option to change your entity structure so we can talk about some sort of reorganization if that's one of your priorities. All right, so just quickly, one more feature on the control concern. If you have a regular entity set up just with voting rights, you want to keep it simple, it's member managed. You can also still structure your voting requirements, especially in limited liability companies and LLCs. Corporations are more of a creature of statute, so here you have to adhere to statutory requirements, and some of them do have voting requirements, so you have to follow those. With LLCs, typically you can customize them. So the statutory requirements are only applicable in certain instances if there is no other agreement, like an operating agreement in place, where you can customize those voting requirements. So for anyone here who's concerned about control, you can make sure that most of your decisions are subject to a simple majority vote, meaning anything greater than 50%, because most likely you want to hang on to that majority interest for some time until you're ready to truly transition that business over to a successor. But there might be instances at which point you want to bring on some of your next generation owners. You want to get their consent. Otherwise, they might be discouraged to be an owner because you can outvote them and significantly influence their rights and responsibilities. So here you might want to consider utilizing a supermajority consent, something like 75% or greater. That percentage can be customized. Some teams use 2/3 or 80%. So that might be an option. Unanimous consent is also up here on this slide. I don't recommend that a whole lot because you give a 1% owner a whole lot of control. So how that looks like on a practical level, on the next slide, you can see an excerpt from our voting worksheet. So we spend quite a bit of time with clients to really customize those voting requirements. They get to see a list of potential business decisions they might be making, and then they can decide who is my decision maker. Does that go to the members, or if I'm manager managed, is that a manager decision? And then you can choose what voting requirement you want to tie to that, whether that's a simple majority, super majority, or sometimes for the managers, it might be unanimous consent. The last item we need to look at here, and we just had this great question from the audience, is how the tax status influences your equity sharing plans. And I just want to cover a couple basics before we dive into the partnership and the S-Corp here. When you set up an entity, you have to first decide what your basic legal form is. So that's how the entity is registered on the state level, and it dictates which state laws apply to that entity. The corporation is a creature of statute. I don't recommend it a whole lot. It's really just something people implement if their CPA says there are some benefits to that, but it doesn't let you customize a whole lot. So usually advisors start off with an LLC. These entity types come with their default tax status. On the corporation side, it's the C Corp status, so double taxation would apply here. And on the LLC, it would be the partnership tax status. You can deviate from that default tax status by making a special election. So this is where that S-Corp election comes in. The S-Corp is not its own entity type. It simply refers to an entity's tax status. The reason why a lot of people are interested in that S election is because it gives you a tax benefit on any profits an owner receives. Those profits are not subject to FICA taxes. So you only pay FICA taxes on a W-2 salary that as an active owner you should receive. And then any profits you take out are not subject to FICA taxes. Usually those savings, though, are limited to Medicare taxes because your W-2 salary might be high enough to cap out the Social Security taxes. So that's the foundation. There are those tax savings that you can have with the S-Corp, but the flip side is that you also sign up for a whole lot of restrictions, one of which is that question I just answered. You can only have voting or non-voting units or shares, but you cannot create any other share class that restricts someone's liquidation or distribution rights. The S-Corp owners typically get a W-2 salary. Bonuses are paid as W-2 income. Profits are K-1 income. Those profits have to align with ownership percentages. So again, no flexibility here. With the partnership, all income paid is K-1 income, but you can structure it so it somewhat mimics the S-Corp compensation structure. Guaranteed payments, for example, are fixed compensation. So this is similar to a salary. Special profit allocations can be similar to bonuses, and then you have your regular profit distributions. And those distributions do not have to align with ownership percentages. So more flexibility here, but no tax savings on the FICA side. When it comes to equity sharing, here is where these tax statuses are important. Julia already mentioned if there is an equity grant, it is treated as ordinary income. Your entity's tax status does not really impact that. But where it becomes important is if we are dealing with an equity purchase. So if you're thinking about successors buying an equity stake in your business, the S corporation would provide basis in the equity that they purchased, and the only write-off your buyer will receive is the interest that they're paying. In the partnership, you can structure the deal so that it is basically treated just like an asset sale. You might be familiar with buying a book of business, and you can amortize that purchase over 15 years. So with a partnership purchase, you have that same option if a special election is made. That's called a 754 election. So here your buyer can amortize the purchase price and also write off that interest that they're paying. For equity swaps, the S-Corp is also not ideal because the IRS typically considers this a sale of a book of business. So if you have an advisor who joins you and contributes a book to your S-Corp in exchange for ownership, that advisor most likely will have to pay taxes on the value they received in the form of stock. So they don't have the cash available to meet that tax liability, which is typically an issue. So here now we have to look into tax-free statutory mergers as one option. And as you can tell, this gets a little bit more complex and probably also costly and time consuming. So the partnership is the easier vehicle here. Individuals can simply contribute that book in exchange for ownership. It is called a 721 contribution. It is not taxable at that time as long as just stock is received. If there is a cash portion, we have to be a little bit more careful, but typically this can be done tax-free at that time. So tax status are definitely important. probably a dense topic and we can talk a lot more about this, and there might be some more questions. So feel free to just send a message to us if that pertains to you. But I'm going to hand it back to Julia at this point, who will walk you through the implementation of these equity sharing plans.
But I will wrap up with some of the key implementation and best practices that we'd encourage you to think about and take away from today's conversation with. And my first piece of advice is to start before you need to. I know this seems like a common statement, and you've probably heard it before. But I'm sure you've also heard some of your peers say, because we've definitely heard clients say, I wish I had done this sooner. Start writing things down even a couple years before you think you might be needing them. So start by writing down your goals now so you can kind of map out a timeline or a plan of when you might need some of these tools as it relates to equity sharing, or if you're going to start sharing equity, that you might need to start dusting off your operating agreement and really considering how you're structurally organized and if that supports those goals. So, having your long term goals mapped out will help you create a more intentional equity sharing strategy and, again, a plan that actually helps grow with your business. This also means then reviewing the foundational tools, like I just mentioned, operating agreement, bylaws, any other corporate governance documents to help ensure that your foundation is built to support those goals. And if your priorities have changed, when you filed your entity 10 or 15 years ago, now if you're trying to expand into a multi-owner team, your documents may have been fine at that time based on those goals, but as you are growing and your business has grown, for the success of your long-term equity sharing strategy, and overall equity value, we have to make sure that you're reviewing your documents that'll ultimately end up governing these decisions that you're making and implementing. That's also why it's critical to seek objective and professional advice. Find someone like us who can help cut through all of the noise and all of the options out there. We're experts in this space who have helped teams by listening to their goals and objectives, definitely helped them even prioritize their goals and objectives, and then, help you understand your options and these different pathways and how to get to and achieve these goals, and then the actual implementation of the strategies and the execution of these initiatives so that you know that you have the formality behind these rather monumental business decisions. We play an important role in making sure that you are thinking through all of the practical decisions and solutions to these potential long-term hurdles that might otherwise not be addressed in standard attorney-led contracts. When it comes to valuation, it's certainly important to understand your value as a starting point for any equity sharing plan. It may even be a requirement to have a formal valuation done to support your equity sharing strategy, but it's certainly recommended to keep this up to date at least every couple of years so that you can communicate these changes in value with your current stakeholders or with your phantom equity participants. This will help you really strengthen the outcome of these equity sharing plans. So while we, again, generally provide the recommendation to have a formal valuation analysis done, at least when you're granting or executing or exercising some of these awards, doesn't need to mean that you need to delay the strategization of creating an equity sharing plan. It may be an important step that we fold in, but starting to think through these things early. And lastly, we've talked about the importance of having documented entity and governance documents, and it's just as important to have your equity sharing strategy written down in formal plan documents. Complexity can become the enemy of execution, and again, we help business leaders filter through all of these options that we talked about today and more. We highly suggest find experts, find trusted people in this space to help with the execution of the plans because there's protections that are important to address before they happen. And there are certainly, changes that will happen over time that we want to make sure that you are thinking about, so that we can have plans built in such a way that they can evolve. But we thank you for your time today, and we hope to hear from you.